Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Charts.Markets.com runs down the major markets. He tells us the correction in AI and Magnificent Seven stocks happened as expected. Ross examines the long and short-term outlooks for the markets and gold. He also has a special offer for our listeners. Longtime trader Victor Adair gives us his take on tariffs, market volatility, the U.S. dollar, and the bond market. Editor of Rick's Picks, Rick Ackerman, discusses tariffs, whether manufacturing will return to the U.S., and would Canada benefit from joining the U.S. Founder of the Schachter.Energy report, Josef Schachter, drills deep into the energy markets and looks at what tariffs are doing to the sector. And despite tough talk, he says the U.S. really does need Canada's heavy oil. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Charts.Markets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Ross, welcome back to the show.
Yeah, pleasure to be back, Jim. Had a little breather there, and guess what? The market volatility just continues, and from the technical perspective, and I try and keep mine down to the chicken scratches. Just watch the charts. Forget it, but try and get away from the day-to-day news stories. They're creating the volatility. But, overall, I like to look at everything from the long-term picture right down to the dailies. And this has been quite a stretch the last couple of years. You know, the stock market between the AI and the Mag 7 stocks just had that phenomenal run into the top last year, so that when we look at the big 100-year channel, and we start with that one, and that's the most important one around here. From 1929 right up to the top of here in the last couple of years, hit the top of the channel beautifully 3 years ago. Came back for the retest of that one just in the fourth quarter of last year, and it would be just classic to roll from there, which is what we're doing. So you're looking at now, the classic action following a mania, and it's just a question of how deep the corrections are going to be and how much the money supply is put into motion to try and stabilize things. So, we look at things like M2, the money supply. Used to watch it back in the 1980s. We'd just look at the U.S. numbers every week and block them by hand. And it was a good leading indicator, money supply and U.S. Federal Reserves. When it was easing and things were good, tended to be a leading indicator for the stock market. Usually would be 13 weeks or more, but it was a great indicator. And these days, we are able to look at numbers worldwide. So the global M2 has hit an all-time high as of this month. And each one of the minor pullbacks in that since 2009 has produced an interim low in the equity markets roughly 22 weeks later. And this one was looking for, on that model, for a low to occur in April. And here we are within a projection to the upside, because there's, with this move in the money supply increasing at the rate it is, money's always looking for a home. And, for the last years since 2009, it's been U.S. equity market. Don't know exactly where it's going to be right now. It's the gold market has definitely been one that has appreciated from that. But on the short term, we're looking at the S&P U.S. market as maybe having put in a good short-term low here where it would expect to see it. And with the lead indicator on the M2, you look to see if this kind of base gives us enough for a decent upside move. And I think it's a tradable one. So that's the big picture. In the shorter term, in the last few weeks, we saw the volatility index of VIX get up into the 60s, which is just extremely high. You only see that maybe 3 or 4 times in the last 3 or 4 decades. And at the top of the move, going into the high here on VIX, the panic 2 weeks ago, the daily signals were just jumping out. And the day before the big market reversal, we sent out a note to subscribers showing that we were on a count. We look for 9 as a key count, where you get 9 consecutive closes above or below 4 bars earlier. And it's rare to see that in the VIX index itself. Well, it had an 8 count the day before everything reversed. So the following morning, when we had that huge reversal, was just classic to have created the signal in the VIX. I think this was actually of this style. It's only the 3rd one in the last 2 decades. So you had one of the biggest moves in the market that we've seen in the very short term. So, for all that we look at the big picture, sometimes the dailies fit in and produce some very, very short-term opportunities like we saw there.
What's happening with gold?
Well, gold for us has been doing what it's supposed to on the upside. There have been the odd pause along the way that might have had bigger corrections than it did. But from the high in 2011 to the pullback in 2015, that consolidation, I'll call it, we measured the depth of that and then project Fibonacci targets above. So coming through the all-time highs here a year ago, the target was 33.36, which was met as of this week. That style of pullback, consolidation, and measurement is the same thing that happened if you measure from the 1980 top down to the 2001 low, and you do the same measurement out of there. That produced the high that we saw here, the previous all-time high, and was on the same measurements. Then if you go back to the 1970s, the move from the all-time high at that time around 195 down to 100, measure that base. The original target was 440 on the similar style to what we have right now. The next move would have been into the $700 range. And as we know at that time, the all-time high became 850. And then if you go back to the early 70s, you get the same thing from coming out of the 1972 move. So the target we had on the upside, there's 3 other patterns. It's basically the same pattern, but the same style of measurements, where the target achieved this week looks to be extremely good. And from a bigger perspective, maybe we're just going to have a nice big correction and then the next move to the upside. Because if we look at gold divided by other items, so gold versus CRB versus the crude oil, etc. Well, if you look at it versus the S&P, it's just breaking out of a 3-year base, like really just starting to break out if you look at the weekly and monthly charts. This is what we saw coming out of the bottom in 2002, coming out of the bottom in 1976, and in 1972. So, and each one of those was as the equity market had been up around a high, and if anything, valuations were at extremes, and it was time for equities to give back something, and then the gold market came to life. So on the near term, we might have hit an interim high here I would think that any corrections in the gold market of any magnitude would be just phenomenal buying opportunities. Hope that it's reasonably deep. We're at the seasonal high for gold and silver right now. Typically, this into April is where you would expect to see a high, a correction from here into the spring, and hope that it happens. It's interesting. The miners, the GDXJ, when you look at the index, if anything, is a little ahead of itself on the upside, but it's good to see that we're finally seeing some positive action over in that sector. So if we can get decent corrections, then the models that we look at will, hopefully identify the bottom of these corrections. Because, back in the 1990s, put together a few indices of our own, proprietary ones. Some of them look for exhaustion points on the upside, which is what we're seeing a bit of now. Other ones look for, we call them springboards, when the market pulls back and sets up a good low in an existing trend. Those types of things give you a nice entry point, and I would hope that we end up with that style in the next few weeks to few months. So, for subscribers, when the timing comes, we'll be putting out the signals as they happen. So it'll be both for the bullion and for the related stocks.
What's happening with crude?
Crude oil, the OPEC move, et cetera, caused that pretty big clean out. And from, I think you're stuck in the trading range here, trying not to trade it per se. We'll look just for short-term trading opportunities, but I'm not wanting to get too involved with that one right now.
Ross, what's happening with the U.S. and Canadian dollars?
Well, the Canadian dollar bottomed out here back in March. We had the original low around 68 and change. Then all the tariff news started, and things stabilized a bit here. I guess the most important thing for the Canadian dollar, if we take a look at it versus the CRB index, Commodity Bureau index, and the crude oil market. And during March, April, as crude oil and the CRB cratered and continues down into new lows, Canadian dollar showed good buoyancy. And you always look for divergences there, whether it's bullish or bearish. And in this case, it was a bullish divergence. You had no idea what kind of action there would be on the upside, but at least there was good resiliency as far as the currency was concerned. So here we are about over 72 cents U.S. right now, and there's a lot of overhead as you get into the 73 to 74 cent area. So probably going to see some difficulty up there, but overall, the key will be that if these other markets come back commodity-wise and the Canadian can't keep up with them, that would be a warning signal. But for now, Canadian is outperforming, and therefore trend is up. And you don't want to fight the trends until they become excessive. And this one on the short term really doesn't even look excessive as of today. On the other side of the coin, the U.S. dollar, we're sitting at multi-year lows, and it's been stuck down here, I guess, for the better part of 5 or 6 days. It just had no buoyancy. The index is around 9,900. The bounce was minuscule. We got just a hair over 100, and then right back down at the end of the week. The whole thing is looking like it's probably a big topping pattern since the 2002 top. At this point, the big support is going to be down where we were in 2020 run, around 90 on the index. So trend is down there. And if you look at the euro or the Swiss franc, those ones just doing exceptionally well on the upside.
Ross, anything else we should be keeping a close eye on right now?
Well, I think, the key item is going to be on the equity markets. We dropped to an initial support that, as we roll from 6,100 on the S&P, our target was 4,800. Actually, 4,770 was where the moving averages were on the long-term chart. And we came within 50 ticks of that, 50 points on the S&P, and we've had this good bounce. And I think as we push through the following weeks here, that is going to be a key level to be watching. We've got some technicals that we're looking at, and if things don't hold here, we're really happy with the analysis for possibly identifying where the next turns might be. But rather than have a mindset of what has to happen, we're trying to be open mind. Just look for signals as they occur on a shorter term basis. So I think the next few months are going to provide some just really, really good opportunities. So anybody who has an interest, please come over to the website, chartsandmarkets.com, and 25% off for annual subscriptions. And we hope you take a look at us.
Ross, thank you so much for the update.
Thanks, Tim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, who's been in the brokerage business for 50 years? You've retired officially, but you're still really active in the markets. You can find his website at victoradair.ca. He's speaking to us from Vancouver Island, beautiful Parksville. Victor, welcome back to This Week in Money.
Well, thank you, Jim. It's always a pleasure to talk with you.
We've had very volatile price action across the major markets lately. That's putting it nicely. Before we discuss individual markets, what's your big picture view on this volatility?
I think the uncertainty that has been created by Trump's policies, on again, off again, that sort of thing, has been a big part of this. And then But if we back up a bit, we kind of started this year in the January and February. American stock markets were at all-time highs after having risen, dramatically over the last 10 years and that sort of thing. And I wrote on my blog quite a bit about what I thought was maybe a peaking out or the end of American exceptionalism, in as much as capital had been coming to America for safety and opportunity, and I use that phrase a lot, but that flow of capital had sort of been self-reinforcing, like America just became a magnet for capital. And because there was so much money there and the stocks were going up so much, it was like the stock markets in the rest of the world didn't matter. Now, that's poetic license to say that. Of course they mattered, but, America was just so much out in front of other places. Like if you were an asset manager, you couldn't afford to not be in the American markets. I think pension funds in Canada, for instance, the leading Canadian pension funds would have way more money invested in the American markets than they would have in Canadian markets or German markets or Japanese markets, that sort of thing. So there was all of that, and then people were also into those markets, and they were going up, and, when something's going up, you can never have enough on. That's an old trading expression. And so people tried to get more on. They were taking on more and more leverage because, you just couldn't lose. The market just kept going higher. So we got to that point, and then, something came along and pricked the bubble, and we've had some change since then. And that's been across the board, whether it's in the metals markets, energy markets, stock markets, currencies, credit markets, and so on. So, we had that crescendo, perhaps, or at least let's call it a peaking out. And then when we had the adjustment, I guess if you went to the chiropractor and you got an adjustment like this, you would have thought that they broke your neck. But anyway, we've had an adjustment. It's been dramatic, and this last week. Now, it's just a 4-day week here with Easter. Things did quiet down. But I'll tell you what, there's still stuff brewing in the background. The bull is still in the china shop, and we could have some more volatility, that's for sure.
Why is gold at its all-time highs, up over 20% year to date?
Okay, a couple of thoughts on that. One is it's not because Americans are buying gold like there's no tomorrow. Okay, I mean, yes, you can go down to Costco and buy some gold there, and yeah, the price has been going up in the New York market. But the European markets are more important, and I think the Asian markets are really where it's at when it comes to what's driving the price of gold. I think in a very, very big picture kind of way, and this has been going on for some time, but it's accelerated here over the past couple of years, is that gold physically is moving from the west to the east. And predominantly, when I say the east, that's China. We've seen central banks there buying gold, or at least reporting that the amount of gold they're buying is more than what we've ever seen before. And a lot of very savvy folks in the gold business will tell you that those banks are under-reporting how much they're buying. One of the ways I look at that is the difference in the price of gold in Shanghai from what it is in London or New York. And sometimes it's about the same, but when there's a little bit of a buying frenzy going on in the Far East, the price of gold there is substantially higher. No, I mean, substantially to me is $20, $30 an ounce higher that people are willing to pay for gold in Shanghai than what the price would be in London. So there's been, and then you say, well, why are the Chinese buying gold? I think up until Trump came into office, and there was a reason, there had been a great run-up in the Chinese market in real estate. They'd had a lot of growth, certainly in manufacturing and everything else, but then they'd had call it the kerfuffle in the real estate market. And the real estate market was the biggest investment by private citizens in China, by far and away. The stock market over there didn't matter like it matters in North America compared to how important the real estate market was. And when the bottom kind of fell out of the real estate market, I think the folks there, and this is just, very general, but I think the folks there just decided that they were really going to kind of pull in their horns and they wanted something safe, and they started buying gold. And I think that has been one of the drivers, and it's been encouraged, or certainly not frowned upon by the government, because they like that as well. So I think the real reason that the gold market has been as strong as it is the Asian demand. And then there's all the other things. When Trump came along, it created the uncertainty, and gold was a rising market and continued to rise. The U.S. dollar has been weaker. Interest rates have not been going up, so maybe that's a positive for gold. And, the weakness in the U.S. dollar, say, since January, February of this year would be another reason to be into gold. But usually we see gold catch a bid if there's worries about inflation. I don't know that the worries about inflation have gone away, but they're not as excited as they were before. And gold goes up when there's uncertainty, and there certainly is no shortage of that. So that's the bid in terms of the psychology of it. But I think the real physical end of it is that the Asian market is pulling gold there from the rest of the world.
The U.S. dollar index was at multi-year highs at the beginning of February, but has fallen about 10% since then. What's your perspective?
Yeah, again, let me back up with a bit of history here. The U.S. dollar certainly virtually almost doubled, I guess, from the lows that it had in 2008 to the highs of the beginning of this year. The U.S. dollar index that we trade is heavily weighted with European currencies, and a little bit of Canada in there, and about 12% of Japan, whereas a trade-weighted dollar, which reflects a better mix of things, which has much more Asian currencies in it, and it was at an all-time high earlier this year. Any way you want to measure it, the U.S. dollar against virtually any other currency, save the Swiss franc, just leave that aside for a moment, was at all-time highs or near all-time highs. Now, Asian currencies, particularly the yen, had been, from my view, purposefully devalued or kept low over the last decade and more to facilitate making it easy for the Asian markets to export into the American markets. Anyway, the U.S. dollar was on this roll. You've heard me say capital comes to America for safety and opportunity. That had been going on, the magnet effect and the self-fulfilling, I guess, like a virtuous circle, I guess, a magnet. And the American place was the place to be. And then when it wasn't, you have a market that was maybe extremely overvalued, was vulnerable to a correction. So we've had it fall back. When I say it, the U.S. dollar against the Swiss franc, for instance, Swiss franc has gone to all-time highs against the U.S. dollar and also against the euro. Now, the euro-Swiss franc cross rate has always been one of my favorite barometers for, let's call it risk in the European market. So I think the Swiss aren't happy with their currency being so high, so expensive relative to other ones. They've got an exporting industry as well. So I think they're probably going to try to keep it from going higher, but at least it shows us that this is another way that the uncertainty in world markets, or just worry, call it, is into the currency markets and things are rising. Now, here's a thought on the euro, and I think this is very interesting. The euro the eurozone, let's say, for the last dozen years, has been left behind by the gains made in the American equity markets. It's almost like Europe was like a backwater. I mean, why would you have capital in Europe when you get this dynamic market in the United States? So that, there'd been capital pulled to America for that reason. Another thought about the euro was that this group of countries were never really going to get their act together. They're always going to be arguing with one another, and perhaps the whole experiment of having a common currency just wasn't going to work. Now, Martin Armstrong, I know, has spoken about that over the years, and, he may be right. There's certainly been examples of where it looked like the euro wasn't going to make it as a currency. But I talked with a friend last week who runs a consulting business in Europe, and he has many central banks and large corporations as his client. He's a currency consultant. And his view was that Trump was doing Europe a favor, that Trump was actually causing Europe to do something they had never been able to do on their own. And his thought was that Trump is going to unify Europe in a way that the Europeans wouldn't have been able to do on their own. And once that is seen in the world, that now there's 400 million or whatever it is people in the European zone, and that's more than in the American market, and they have now all of these bargains because they've been a backwater for so many years, that we're going to see a stronger European currency and a stronger European capital markets and so on. That's his view. Whether he's right or wrong on that, I don't know. I can't predict the future, but I think it's an interesting way of looking at things and say, where we go from here with the different currencies.
The S&P fell over 20% from all-time highs in February to the early April lows. It's bounced back about 10%. Do you see the market rallying back to the highs?
I don't. Not anytime soon. Anyway, I think in the context of, as I was just discussing, the American markets had run so high because capital was coming there from all over the world. It sort of accelerated, the gains that the market had. Now I do believe we are seeing the repatriation of capital back to some markets. Now, that's not a tidal wave. I think that's it's an initial thing that's happened. And you could say there's been some good reason for that. One, the American market is more uncertain now with Trump as the president. The left-behind bargains in Europe look, hey, maybe they're not so bad after all. And if you switch out of the American currency, go back into euros, you're going to get more euros, than you would have years ago. So it just it makes that thought of would we ever get back to this year's highs, I think that was just so overdone. The market's going to chop back and forth, and maybe we go back to the highs, but I think that was going to be a real high watermark, and it'll be a struggle to get back to be above the highs that we made in January.
The bond market collapsed last week. Yields rose the most in years. Why did that happen, and what now?
Yeah, the bond market last week, I think, had its worst week in years. It certainly felt that way. It was just, sitting in front of my screens is like, holy mackerel, this is really moving. Now, everybody's thinking, what is going on? For instance, the Chinese dumping bonds? Are any of the Asian countries that have huge U.S. dollar surpluses and they're held in bonds, are they selling? Why are they selling? Are they selling because, for instance, we're in a trade war, so, you're going to hit me, I'm going to hit you back, we'll hit you in the bond market? There was a lot of things that people were commenting on, a loss of confidence in American capital markets. Now, that's pretty serious. But, when the markets are moving fast, people are going, why? And you come up with these different ideas. Now, it's calmed down. Certainly it's calmed down this week. And I think actually last week was maybe an exaggeration, like we got overdone with this whole thing of a loss of confidence in the capital markets. But, believe me, there is ammo available, going forward for more worries about the confidence in the American capital markets. But I think that was kind of at the heart of it last week. It was it's so unique an opportunity or a unique a time to see the American stock market falling, the U.S. dollar falling, and U.S. interest rates going up all at the same time. That just, in most of the ways of you're looking at the market, you say, this doesn't compute. Why is this? So it was really I think, an America-centric problem, and clearly it kind of blew over a bit, as it were, when there was some backpedaling from the American administration on what they were going to do with tariffs and this and that and negotiating and all that. So, but I think it got pretty intense there for a while. We had, and one of the measures I have of how intense things are, I look at the implied volatility in the option markets of the different things that I trade, and I was seeing just volatility exploding, whether it was crude oil or gold, even gold. Certainly the credit markets and the stock market. I think that was it. I think it's quieted down for now. This week has been much quieter than it was last week in terms of volatility, and maybe it's blown over here for the short term.
WTI crude oil tumbled to $55 last week, the lowest price in 4 years. Your thoughts on oil?
Big picture thought, and one of the fellows I subscribe to is Doomberg, and he has been for a couple of years making the case that oil is going the way of the dodo, and the shift will be to natural gas. And then, as Robert Bryce might say, the future is going to be from natural gas to nuclear. So, and you carry that thought further, the last barrel of oil that comes out of the ground is going to be worthless as opposed to being, worth $1 million, because we are making a switch. The bullish view on crude, of course, is that not all countries are able to do that. They want to grow anyway. One of the biggest demand markets is going to be the emerging markets, India in particular, huge population. They want to, have a more modern society and demand more energy, and the easiest way to go on that would be, using the price of crude would go up as a result. But again, like the bond market maybe got overdone last week, crude oil maybe the same. We tumbled down to $55. There had been a real ramp up I could see on the New York market of speculative short positions over the past month or so. I think we made a spike low at $55 on crude. We're now back at the end of this week. I think we're around $64, $65. So we've had a bounce back. But maybe the oil market is being put on notice here of a transition from what fuels are important. It was interesting to see for instance, that while crude was tumbling the way it was, nat gas prices were not. Nat gas prices were staying pretty steady at higher levels, than they've been in the past couple of years. So maybe there's something to that. And the volatility in the crude oil prices was just awesome last week. So again, that's quieted down this week. I think, we'll not to say there won't be more problems. Certainly the United States is negotiating with Iran, and the Treasury Secretary has said basically they want to shut down Iran's ability to export crude. In a world that uses around 100 million barrels a day, our surplus maybe or whatever is is 1 million barrels, so 1%. So it doesn't take much of a shift, in other words, to have the world move from being in a oversupply to being undersupplied, and in something that is very, very critical. That's going to result in dramatic price changes. So, what else is going on with crude? I mean, certainly, if the war between Russia and Ukraine quieted down, that might see more crude come available to the world market. That's just, and I guess the other aspect of it. Sorry, it's been a long week. The weakness for crude would be come from the idea that there's going to be a slowdown in the Western economies. There may be going to be a recession. Some of the central banks are worried about that. Some of them aren't. But certainly if the economy slowed down, less demand for crude, and the opportunity for OPEC Plus to increase production, maybe looking down the road and saying, hey, let's sell this stuff while we can get some money for it. So we've always got a supply-demand balance of some kind, and right now, or at least lately, it seems as maybe the market is pricing there's more supply out there than there is demand, so prices have been under pressure.
Before we wrap up, how do you change how you trade when markets turn out to be volatile like this?
Okay. Very specifically, I would start with I don't have to trade. And some people do. If your job is you're managing other people's money, you've got to do that, and so maybe you got to switch this and go to that. For me, I can just sit back and not do anything. No, I don't. I will if I have the sense that my volatility or my risk has gone up. I'll just I'll reduce my size. That's definitely something to do. And just be more cautious. Got to be very, very careful as to correlations between markets. For instance, let's say at one time if the Japanese yen was going up, the bonds would be going up as well. So if I'm already long yen and I want to add, if I want to get long bonds, I'm actually doubling up on the same trade. So I've got to be cognizant of my correlations. Now, the opportunity side of it is, there's the risk and opportunity, as I was just saying with the volatility. Volatility just explodes when, say, liquidity dries up or prices are moving around very, very quickly, and there's fear in the market. By the way, fear drives markets faster and harder than greed does. But when volatility ramps up, I found a couple of really good opportunities last week where volatility was really high. Now, if volatility is up, that means the option price goes up, and if I can get in there, if there's something I want to sell, so I'm going to more likely be an option seller when the volatility is up. And for instance, in the bond market, last week I was able to get paid a lot to be short puts in the bond market, like people were abandoning them. So that was probably one of the key things I do when volatility ramps up is I look for opportunities to sell vol. And at the heart of that, sorry to be long-winded here, but at the heart of that is I believe volatility is a mean reverting metric. Okay, volatility doesn't trend. Spikes either way, come back to a mean. So I like to fade something when that is, let's say, go against it when something has spiked outside of a mean level.
Victor, thank you so much for being on This Week in Money.
Jim, it is always fun to talk with you. Thanks for having me on.
My guest has been Victor Adair. Check out his website, victoradair.ca. Coming up, Rick Ackerman, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He's speaking to us from South Florida. Welcome back to This Week in Money.
Well, thanks for inviting me on. Always a pleasure, Jim.
Rick, before we get into the interview, can you tell us a bit about Rick's Picks?
Well, I track a bunch of things, widely followed trading vehicles, S&Ps, gold, crude oil, Bitcoin, whole bunch of things, and do a weekly commentary. But you can get a free trial, no credit card necessary, just by going to rickackerman.com and clicking up top where it says free trial subscription. So we have two great chat rooms. The rooms draw great traders from all around the world, and they're a very gracious and generous group. They like to share trading ideas in real time, and trading should be fun, and this is a good place to have it.
The stock market's just had a violent correction. Could this be a correction in an ongoing bull market, and do you think the bottom is in?
Well, I think it was a full-fledged bear. We were down a little more than 20% off the top, but on that Sunday, a couple Sundays ago, when the whole world was sort of freaked out by, I guess, Trump's latest tariff pronouncement, there were some pretty dire predictions, but my prediction went no further than a few hundred points below in the S&P. So I had a 48.20 target, came down to 48.35, and it's since bounced close to 700 points. So I hit a pretty good low there, and my theory is still that may be the bear market bottom.
The stock markets tend to be a predictor of the economy in the near future. Is this correction predicting anything?
Well, I think it does. If we've hit a bear market low, I think it's safe to infer that we're not going to have a recession. And of course, we're getting warnings from Bloomberg and the usual places that we're just about in recession. But if that 48.20 was the low, we're not going to see a recession. And then one other thing is that all of this blather about the tariffs and how they're going to wreck the world, they're not going to come to anything. The whole tariff trouble will just kind of blow over.
Do you think President Trump has plans to stop the planned New World Order by using tariffs?
Well, he certainly disrupted them. I think less because of the tariffs, really, than things that where he had, if not the complicity, he had the help of Jerome Powell. You know, Powell's been resistant to wholesale loosening of credit. And, of course, this has kept pressure on Europe. They can't very well be easing when the U.S. is staying tight. And I do believe the theory that the willy-nilly dumping of treasuries last week was a planned attack by our European supposed allies on the U.S. financial markets. There are a lot of big U.S. hedge funds well, let's call it a carry trade, but it's been referred to as a basis trade. And it's essentially a hedge where you're long treasuries and I think short repos, and you only pick up a few points, and the risk apparently was enormous. So when the Europeans started dumping treasuries that they'd stockpiled for explicitly that purpose, these hedge funds got in trouble, but it was really an attempt by Europe to push Powell into easing to bail out some of these hedges. But Powell stood his ground and it looks like the worst of the Treasury dumping has passed, and the U.S. is still standing. So Europe, they can all band together and try to work out their own tariff counterattack, but it ain't going to work because they need us a lot more than we need them.
Do you think President Trump is likely to focus on tariffs moving forward with a plan to eliminate federal income tax?
Well, I'll believe that when I see it, really. You know, Trump talks a good game, and sometimes he overplays his hand. I don't think we're going to see a tax moratorium anytime soon. It's be tough enough, really, to get no taxes through for Social Security, income, and waiters' tips and such. So, but Trump is just going to keep shaking things up, really, just so that that all of our erstwhile allies know that he's capable of doing anything, and he can bluff, but sometimes not. But in the end, I think Trump will get us closer to what he's looking for, which is a more normalized global trade that's not booby-trapped and rigged with tariffs and currency devaluations and all of that.
Could central banks be on the chopping block?
No, I don't think so. We need a central bank if for no other reason than to keep the Europeans from ganging up on the dollar and our own financial system. So Powell has certainly done that. He's not that the dollar has been particularly strong lately, but it's still in the dollar's decline is really in the context of a longer term bull market. And I think even if Trump likes a cheap dollar to stimulate trade, I think his patriotic side will get the better of him, and he'll eventually advocate for a stronger dollar, because a stronger dollar is fundamentally a stronger America economically. So I think that's what we're looking at.
President Trump says Canada becoming the 51st state is still on the table. Do you think Canadians would benefit from becoming part of the U.S.?
I wonder. So many of them cross the border for medical care because the waiting list is not so long in this country for hip replacements and stents and all these surgeries and procedures. But I don't see Canada signing on anytime soon. It's being the 51st state, they're going to lose all their friends in the world. Everybody thinks, well, Canada, what harm can they do? They're so innocuous. And I remember even when I was backpacking in Europe in the 60s, a lot of Americans had knapsacks with Canadian flags on them, because even then the U.S. wasn't universally popular, but Canada is universally innocuous, and I think they'll keep it that way.
Is commercial real estate a concern?
Yeah. I mean, even if I make the argument that perhaps Trump has put this country on a glide path to better times, reshoring a lot of American manufacturing and as I mentioned earlier, normalizing trade. We've still got to cross a very deep valley that's going to be coming economically with the collapse of the commercial real estate market. None of the cities have faced up to it honestly by marking properties to market. So many leases on urban office towers have been extended with the pretext that the economy will return to solider footing. People will start coming back to the office to work, but none of that's going to happen. So eventually the cities are going to have to take the hit, and the couple of them, San Francisco, will probably be the first to go.
Are cities likely to see revitalization?
No, I think cities are really dying, and of course that raises the question of what feeds the suburbs, and the exurbs. Those people make their money very frequently from activities that are still at least nominally or perhaps electronically centered in the cities, but the cities aren't coming back. There are a few exceptions. I visit Charleston every now and then, and it's the only city I can think of its size that actually seems to be getting more, the economy is growing even more robust. But there are some other places, Austin, I guess, has got all the prosperity it can stand, but some of the big old cities are looking at very difficult times. And even San Francisco, the center part of the city has collapsed. From Union Square, you work your way downhill into the Theater District, and then Market Street, and it's all dead. And that would kill any other city. But in San Francisco, the neighborhoods themselves have retained a certain vitality, and some, like Noe Valley, are probably even more prosperous than when I left the city back in 1999. So, but if San Francisco loses control of basic services like trash pickup, but more importantly, police and fire protection, then those neighborhoods are going to start deteriorating as well. And you can't say it won't happen because it's already happened in Chicago, where supposedly even a homicide call does not necessarily bring a police response.
Is there any hope for inner cities converting former office space into residential?
No, that's virtually impossible. And even if you can deal with the physical part of it, how do you take an office building and install showers and bathrooms and kitchens, which is, it raises the cost of the units. The units would have to be so heavily subsidized because the construction itself is far more expensive than residential construction. So you wind up paying $6 million for a little apartment. And, but the other part, the other reason is, if you just put yourself outside of one of those converted office towers at 8 a.m, who do you see leaving that office building and wearing suits, and what jobs are they going to? So that question is a dead end, really. There are no jobs, and there are no suits, and there are no people going to work. So no, there's not even a remote chance that those buildings can be converted for other uses.
What do you think manufacturing returning to the United States will look like going forward?
Well, there's just a glimmer of it up in Detroit. There's some assembly plants, I think one involved with engine assembly, and it's been everything's been rusting there for years, but now the cost of getting parts back and forth across the border is an encouragement to start up the assembly plants that are already there. So I know about this because there was some news segment that had a union guy saying, look, we're already starting to see jobs. And even though this is just a very small glimmer of what could happen, it's going to be a long trail before America brings its manufacturing back here. And of course, it will have a high cost because some things we just need, and we won't be able to make them here until we have the raw material and the ability to assemble and manufacture. So that's going to take a while, and what we need from abroad, we're going to have to continue to buy. And I guess that's what Trump's working on right now to smooth the path for trade during this period when America is rebuilding its manufacturing capability.
What's going on with gold hitting new record highs, it seems, every day?
Yeah, the cool thing about gold, I've had a target that was way up there since gold was around $2,800. I'm still using a target of $3,533.90. That would be basis the June COMEX contract. So even though I could see the rally coming, I really didn't anticipate the strength of it. We're so used to seeing gold rally and then it gets smacked down really hard that when it just takes off, even bulls are reluctant to buy it. You're thinking, oh, geez, it's come so far so quickly that if I buy now, I'm liable to get smacked down. But in true bull market fashion, this launch phase has been so powerful that if you were in any doubt at all, you never got aboard. It hasn't pulled back. Gold hasn't what I would hasn't had what I would call a full correction, meaning an ABCD pattern correcting all the way to the D target. It hasn't done that in more than 3 years. It's not even correcting, let's say, smaller ABCD patterns. So gold, you really had to be a believer, and you had to be on board the whole way up in order to capture this move.
What's going on the crypto front?
Well, crypto is, it takes a period of market strength, at least maybe 2 or 3 weeks, before the cryptos start, I'm not going to say lead the charge, but they've been a little bit timid. You know, the cryptos have been kind of go along, and sometimes they'll go a little bit against the trend. They're heavily controlled, but we've corrected down from a high of 108,000 down to, I think, around the mid-70s. So Bitcoin's had a pretty stiff correction, and it's trading around 85K right now, and it really needs to pop above, let me give you a good number here, above, let's see, 90. It really has to hit 100 grand before it announces that it's ready for another leg up. And I have a theoretical target as high as, I think it's 144,000 on Bitcoin. I'm not a big believer in Bitcoin, the movie. I think Bitcoin is just a big hoax, and there really is and truly, factually, nothing backing Bitcoin. And the only argument that ever gets made for Bitcoin being worth anything is scarcity. And of course, scarcity is no good argument at all. That's anything that's scarce is not necessarily money, especially something that moves with the speculative force, with the volatility of Bitcoin. But even though I think Bitcoin's a hoax, that doesn't prevent my forecasting that it could go $50,000 higher from where it is now.
Rick, what's your general feeling about the economy right now?
Well, it does look pretty shaky, and I think you could make a good argument that we're about to go into the drink. Consumers are pretty well tapped out. I think that the real estate market has probably peaked, and of course there's not going to be a refi cycle, maybe even in our lifetime again. It's so hard to picture interest rates coming down low enough that people would benefit from doing refis at lower rates. So the refi cycle has a way of kicking the economy into gear, and we won't have that this time. We'll just have consumption, good old John Q. Consumer, who is somewhat stymied these days by just inflation. Everything costs more, and if anything, the consumer being tapped out could bring a little bit of softness to prices, because things are getting outlandish to the point where, you know, some households are doing it without eggs and meat and protein just to get by. So that takes a little pressure off prices. So the economy is a little shaky now, but again, looking at that 48.20 target that was hit in the downtrend of the S&Ps, it's possible that the economy has seen its worst, and we'll have that would be really unusual, but we could have an investment-led recovery.
Where can our listeners subscribe to Rick's Picks?
Ackerman.com. If you just go to that URL, at the top of the page, there's I think it says free trial, and if you click on that, you'll be in like Flint. No credit card necessary. And I hope that information is good, because I just talked with I brought a marketing guy out of retirement, and he said, well, the free trial link hasn't worked, but if you have trouble with the link, just to write me directly, rick@rickackerman.com, and I'll fix you right up.
Rick, thank you so much for being on This Week in Money.
Well, thanks much for inviting me on, Jim. It is always a pleasure.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Coming up, Josef Schachter, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter.Energy Report online at Schachter.EnergyReport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money.
Oh, my pleasure as always, Jim.
Josef, can you tell us a bit about the Schachter.Energy Report and how people can subscribe to it?
Yeah, the Schachter.Energy Report is there's two parts to it. One is our macro work, which we provide for free, so people can just go to the website, and I'll give you that in a minute. And we do that once a week on Wednesdays, called Eye on Energy, and it's a good way for people to get an idea of what's going on with OPEC, with the EIA, inventories, and the price of oil, and what's going on to drive the movement in the price of oil. So that's our free product that we use as to kind of help everybody and guide people on that side. And then our paid product is covering 37 Canadian companies: pipeline, infrastructure, royalty, Canadian E&P, oil, natural gas, energy service, and that is our paid product. And people can go to www.Schachter, Schachter, energyreport.ca, and they can get access to some of our free older product so they can see what it's all about. And then there's reports there, interviews there. This interview will be there, in a few days after you guys send it to me, so that you can see some of the prior interviews that I've done with you. And the key is, the free product is there to give you kind of a mindset that you want to be involved in energy, that you want to own stocks in the sector, and then the paid product gives you the different types, the large market caps, strong balance sheets, those with dividends, those without dividends, and so people can sit down with their investment advisor and decide what's appropriate for their portfolios. But my view is I'm bullish on the sector. We got buy signals just a few weeks ago that we can talk about. And the key thing is I think that we're looking at a multi-year bull market where the price of oil before this is over, before the end of the decade, will reach all-time highs. I think in the fourth quarter we're going to be over $80 a barrel, $90 in 2026. So that is way different than the consensus where the price of oil today is 64 and people are bearish. I'm in the bull camp, and that's different than I was in Q1 when the price of oil was 85, and I was cautious thinking the price would go below 70, and you can remember that from our conversations at the time. That turned out to be correct because of the tariff issues and also the inventory build and the fact that demand wasn't as strong as people thought.
The price of crude plunged with a violent stock market correction. Is there a bullish case and a bearish case for crude?
Yeah, the price today, was 64.30 range, and we were down at 55, as you know, during the worst of the crunch that we had in the market. I don't think the crunch in the market is over. I think that there's going to be more challenges with tariffs, and I think the earnings guidance from some companies, the big bulk of them, come in the next few weeks. We've seen one of the healthcare companies announce some bad numbers. I think it was United Healthcare, and the stock was down big on Friday, which dragged the Dow down. So that was, part of the problem. The Dow closed down 527 points. So the bull case is that by the end of this year, Iran does not sign a nuclear disarmament deal, and then the United States puts sanctions on them so that they can't sell oil. They're producing about 3.3 million barrels, according to the March OPEC report. So if they lose 1.5 million barrels, that's important. The other one is Venezuela, where the Americans have already put sanctions on. They were producing in March 911,000 BOEs a day, and if that comes down by 400,000 or 500,000 barrels, we could be talking 2 million barrels off the market from them. And if demand grows by 1 million, some people are saying 1.3 million, but let's take 1 million just for easy math, there's going to be 3 million barrels that are going to be needed that won't be available, and that will drive prices higher. So right now, we're caught up in the tariffs. We're caught up in, the Iran's, issues of Iran nuclear talks. the weakness with China, the issues there. But I think the bull case is one that I believe will be there, and $80 in the fourth quarter is the bull case. The bear case is that we go into global recession. In other words, the tariffs knock the economies off their pedestal, and consumers, of course, won't be really feeling the tariffs until inventories are gone from the, let's say the auto dealerships or Best Buy or whatever. But once those inventories are gone, which are pre-tariffed, then you're going to have the tariff product, which will be much more expensive. And if that's the case, and we have tariffs on, food and at the grocery store, produce, when we go, that comes in from the States, all of that will then potentially put us into recession. We know consumer confidence is very negative and fallen rapidly. So the recession, global recession, is the one where you could argue that the price of oil would go down into the 40s maybe, and then just bounce around 40, 50. And during that time, the industry, of course, would stop drilling, and supplies will become tighter, and all of a sudden that'll set up the next cycle. But my view is the bull cycle is the one that wins, simply because I don't think the world goes into a severe slowdown. It might be, barely, neutral, and some countries like Germany might be in recession, but others will be showing some growth, and that there will be some increase in demand. May not be the 1.3, 1.4 that EIA and OPEC are talking about, but if it's a 1 million barrel increase and you take 2 million off, 1.5 million from Iran and 500 from Venezuela, then you've got yourself the case for higher prices by Q4.
Since the beginning of the year, the U.S. dollar has dropped significantly. How does this affect the prices for energy?
Yeah, when the price of the currency goes down, that's usually helpful to the price of oil. So we've seen, a 5% or so decline, maybe more, in the price of the U.S. dollar. And, of course, gold has taken off because, people are losing faith in currencies. So you're looking at the U.S. dollar weakening for that reason, and also concern about, is the U.S. economy going to have, the problems with growth going forward, and also the issue of, people are saying, do you really want to be involved in the U.S. economy, with Trump's policies? And people are saying, do we keep our capital there? Do we move it to Switzerland? Europe is, the one thing we've seen is a lot of gold leaving Europe, going to the United States, and that might be just the issue of, the concern about tariffs, and also the concern about potential expansion of the Russia-Ukraine war. So gold has been moving to the U.S., and of course central banks have been big buyers of gold because they want to not have as much U.S. dollars. One of the reasons why the U.S. dollar is dropping is that foreigners are selling U.S. government paper. So, we had that spike up of 60 basis points in the 10-year Treasury. Japan and other countries that are big holders, like I think the world largest holder is Japan, second is China. China's been selling for a long time, but Japan, I think, sold, and that's why I think the U.S. and Japan are having the chats right now to resolve the tariff issue, because I think both sides know it's serious, and I think Japan, to get attention, may have aggressively been selling treasuries and driving interest rates up, and that made the decision that they better talk to Japan, because they probably wanted to stop that selling.
For the past couple of months, the Canadian dollar's been rising. Is this likely affecting pricing in the energy markets?
The Canadian dollar's been going up because the U.S. dollar is going down. I don't think it's anything specific in Canada. There is some optimism that there might be, some strong leadership after the end of the month to handle Canada's challenges with the U.S. tariffs and with President Trump and the negotiating teams. But I think it's more where we're seeing the euro-dollar rally, we're seeing the Canadian dollar rally, and the U.S. dollar go down. The biggest currency in the world in terms of liquidity is the U.S. The Canadian one is much smaller than the euro-dollar. So I think what we're seeing is a U.S. dollar impact, not anything specific that we're doing in Canada.
Tariffs are the big focus. Tariffs in the U.S., tariffs in Canada. What could tariffs mean for the crude oil and natural gas markets in Canada?
Yeah, this one's an interesting one because the Americans are our biggest customer for Canadian oil and also Canadian natural gas. And the U.S. needs us for it. And the refineries in the Midwest of the United States and the Gulf Coast need our heavy crudes because they were built and configured for heavy crude, and they can't switch easily. It'll cost many billions of dollars and many years to convert those refineries to handle the light oil from the Permian and the Eagle Ford, which would be which is what the Americans are exporting. And the U.S. exports have grown significantly. The last week's data shows that the exports from the United States are 5 million barrels. So the Americans are selling a lot of oil to the world, and part of it, I think, is, of course, because the price of oil is down and it's cheap. But the other part of it is, I think, that we're looking at countries trying to lower their deficit, their trade surpluses, and have with the U.S. having deficits, and by buying more U.S. crude oil, they can shrink those and be less of a problem for the trade negotiations that are going to go forward one-on-one with each country. They're talking over 75 countries ready to talk, but again, these things will take time. And of course, Japan is going to be, let's say, the first one, and maybe they can, if that's successful and resolved properly, then it'll be the format that they use with other countries around the world.
Would it be dangerous for Canada to use energy in its trade war with the U.S., Ontario, Quebec, Newfoundland withholding hydro, or taxing it, Alberta holding back its heavy oil or putting an export tax on it?
If we want to shoot ourselves in the foot, I think what we've heard from Trump is those that have not retaliated like China has done are ones that they'll negotiate with. Japan didn't retaliate, so that's why they're the first ones in the gate for the negotiations. So I think the reversal by Premier Ford over the electricity was a smart reversal. And I think that kind of lowered the temperature a little bit between the U.S. and Canada. I think the U.S. is ignoring us until after the election. I think they want to see who gets through, what are going to be the new policies, and then, of course, does Trump get along with that person is going to matter a lot. And the polls are showing that Carney and the Liberals have got the lead. But if you look at the rallies, it looks like it's going to be the Conservatives. The French debate last night, there was no real winners, except maybe Rebel News that got to ask more questions afterwards in the scrum room. But I think that the debate tonight, which is at 5:00, it will be very heavily watched. The English version in about 2 hours from now, from our conversation. And so I think that's going to be important for Canadians to watch to see who they feel is going to be the one they want to carry the torch and negotiate with the U.S.
Concerns of global unrest. Does it look like there's a war premium in the energy markets?
Well, as I mentioned, right now the price has gone up because everybody, last $3, $4, $5 from below, say 58 to 64. Is because of the concern that if the Iranian nuclear talks don't go well, U.S. sanctions will be put on, or the U.S. might strike Iran. There was reports out today that Israel was planning to attack, and the Americans said, no, don't. Let's give diplomacy a chance. And then if it doesn't work, the U.S. has moved a second carrier group into the Arabian Sea, so they've got now enough firepower in the area and they have the weapons that can go deep to destroy the deep underground nuclear facilities. So we could see some action if these negotiations fail. I think the Iranians are just going to drag it out, give a little bit, then back off, give a little, back off. And so just like we're seeing with this thing with Hamas and trying to get a deal to free the rest of the hostages, it just takes time and patience required. And we'll see if, at the end, if there's a deal. And if there's no deal, then the Americans will have the military forces in the area to take direct action against the Iranian nuclear facilities, maybe the military facilities, and if they really, get peeved, and of course Trump likes using more aggressive adjectives than that, they could attack even the energy facilities, the refineries, the pipelines in Iran, and effectively cripple their economy.
And real estate sales are drying up while inventory's rising. Could this be the canary in the coal mine for energy markets?
I think it's the canary in the coal mine for the overpriced markets, especially we're looking at Toronto, Vancouver, Montreal, where it's impossible for people without getting help from family to buy a starter home. All the government people, the running for the prime minister's job, are the leaders of all the parties are all saying they're going to do, take Crown land and build affordable housing and whatever, and remove regulation. I think housing is a separate issue. I think prices are beyond what people can afford. And so with the problem is that we're not building enough supply, and then we had a massive amount of migration into the country, and so rental rates went up, which drove housing prices up and apartment prices up. And now we're seeing that almost all the leaders are saying we've got to slow the immigration down versus what Trudeau did. And what I was shocked by in the debate yesterday is that Carney's talking about slowing the rate of growth of discretionary spending, which for 10 years has grown at 9%. Well, if the Canadian economy is only growing at 2 to 3%, why the hell is government growing at 9%? So just like in the States where, the Doge is there and they're trying to, cut back on all the ridiculous spending by the Democrats and the Biden during his 4 years in office, we need to take a scythe to the Canadian, the bureaucracy, if the system, if the computer systems don't work, put in better systems and make sure that there, if deficiency is there, and if there's regulations in place that don't need to be there, get rid of them. If there's programs in place that were put in 100 years ago that aren't needed anymore, get rid of them. If there's people collecting CPP and OAS that are 125 years old, I think there's an issue there. So just like the Americans are finding a lot of stupidity and graft and problems and theft and problems in their system, I bet you we would find the same here, but we're just not looking at it right now.
Are the energy markets seeing any inflation?
There's a mixture. Tubulars, because of steel prices going up, that's going to impact the drilling industry, pipelining, etc. Sand costs will go up because you're going to have rail going up, and you're going to have the tariffs hitting there. On the other side of it, talking to the energy companies, when I'm talking to them, they're saying that because the drilling industry has slowed down and there's a lot of equipment available, the price per day rates for drill rigs is coming down, and also there's a lot of competition for fracking. And this, so you're seeing the frack prices coming down and margins are coming down. It's worse in the States because, of course, they've got way bigger drilling fleets and way bigger frack fleets. If you look at the U.S. rotary rig count that came out today from Baker Hughes, there's 585 rigs working in the States, down from 619 a year ago, so down 5.5%. And the big decline is in the gas drilling, 98 versus 106, oil 481 versus 511. In Canada, we're still up, and that's because of oil. So we're 134 versus 127 a year ago. But the key thing is 87 rigs are working to drill for oil versus 60 a year ago. But for gas, only 47 are working versus 67. So we're down 30% on natural gas, while we're up 45% for oil. And that's because of the TMX pipeline into your province, where it's not even full yet. And so, China's announced that they're going to buy more Canadian crude. And so the West Coast of Canada is getting the benefits of the expansion of the TMX pipeline.
After peaking in March, the price of natural gas has pulled back. Is there a bullish case and bearish case for natural gas?
Yes, there is. We've been talking about that, for quite a while as well, and I'm a bull on natural gas. We're about $2.50 for AECO, and the U.S. is around $3.25 for U.S. NYMEX. And the bullish case is the LNG exports, and of course data centers and more demand for electricity. We're going into the summer soon, and that's going to be air conditioning demand season. So the bullish case is that we have strong demand, more data centers are built. The U.S. now is exporting 15.7 BCF a day, and that's an industry that wasn't even there, a decade ago. And they're talking about that doubling between now and, 2030 or so. So there's a lot of increase in demand for LNG. The Chinese have stopped buying American LNG, but Japan, South Korea, Europe are still very big buyers. Canada will get our first LNG. You'll probably see some interesting tankers going by the west coast to Kitimat, and the first cargo probably will be going out in June or July from LNG Canada, and that'll be 1 BCF a day. We produce about 18, 19 BCF in Western Canada, so it'll tighten things up. But by the fourth quarter, they'll be producing about 2 BCF, so that's over 10% of the Canadian production. That really will tighten things up, and a lot of people I talk to think we'll be looking at AECO being $3, maybe even $3.50, and then in winter 2025, 26, maybe even higher than that. So the bullish case is there. The bearish case is the recession case. So if you believe that we're going to see recession and, China doesn't buy American LNG, and South Korea and Japan see economic weakness. Europe has moderate weather this summer, so they can fill up their storage for winter of 25, 26. And then you could argue a bit more of a bearish case. But again, I'm not going to bet on the weather, but I think that the fact that the storage levels in Europe are so low that they're going to need to buy whatever they can. If China's not willing to buy it, you'll see cargoes redirected from heading to Asia to China and being redirected to Europe to fill the storage in Germany, France, which the overall, is right now about a third full after the winter. They need to get to 90% by November 1st. Germany is below 30, and I think France is below 30, and Germany is below 25% storage. So they've got to be buying a lot of cargoes to get ready for next winter.
What's the latest on the rig count?
Well, the rig count, as I mentioned earlier, we the U.S. is 585 versus 619, and the oil numbers and the natural gas numbers are down. In Canada, we're slightly up because of the oil numbers, because 87 rigs up from 60 a year ago, and that's because the oil window is there to fill, to drill for, heavy oil in the Clearwater or the oil sands in the SAGD producing, and then of course that gets shipped from northeast Alberta and Fort Saskatchewan area. It goes in the TMX pipeline all the way to the BC coast, and then the tankers take it. They were taking it to the United States for a while to the California refineries, but now that's those cargoes are probably going to be heading more and more to Asia, simply because of the tariff. And I think it's also part of the politics of if the Americans don't want our oil and want to fight us on it, we'll find new markets.
What are the large cap, mid-tier, and junior energy stocks doing?
Well, it's not been a pretty time. You've seen a lot of these stocks get shafted pretty hard and go down. I'll just pull out some of the big cap names for you, and it's not been fun. If you take, for example, CNQ, which is the largest of the companies, the high for the year was 54.69, the low 34.92. It's up 81 cents on today, 39.88. If you go to one company that's had a tough time, Cenovus, it was 29.46, low 14.48. $16.75, up 59 cents today. So you've seen, there's some weakness in the sector. Even Imperial Oil, which of course is, one of the ones that's doing a lot of stock buybacks. Stock today, 88.37, up 2.13, 2.5%. The high for the year was 109. The low for the year was 83. So it's closer to the low than the high. So it's been tough. Even Suncor, another one of the big names. High for the year was 58.5, low 43.59, 47.80 today, up 94 cents. So the bounce of $2 on Friday because of the Iran concerns bumped the stocks up. But if the Iran concerns back off, which I believe they will, as the negotiations get dragged on, and we have weakness in the general stock market, so you see intermarket margin calls. So people who are levered in AI stocks start getting hurt from weakness in the Nasdaq, or if it's a hedge fund that also has commodity positions and they get margin calls, you sell what you have to sell, not what you want to sell, and leverage to positions in the commodity market mean that you have bigger swings there, both on the upside and the downside. So my guess is we will probably see a test of the mid-50s over the next 2 to 4 weeks. And so by the time we talk next, we'll have seen that weakness. But we're recommending to people to take advantage of the weakness, to buy names that they like. There's many, many stocks that we cover that are yielding greater than 10% yields. So there's a lot of very, very attractive companies out there, strong balance sheets with fabulous dividends. And I'll give you a couple of names. You can look at a, Freehold Royalty just under 10%, Whitecap just around 10%, Africa Oil, Canadian listed company, over 11%. You can see over 10%, almost 10% on Surge.Energy, Alvo Petro, 11%, In-Play Oil, 12%. So there's some great names. And the question is, do you want to own large cap or intermediate cap? You can look at pipeline and infrastructure stocks. And so there's yields right across the board that are attractive. And that's the product that we provided that I talked to you earlier about in our paid product. So people can look at the market cap they want, look at the dividend yields, look at my balance sheet comments. One of the things we do in our research that is different is because it's a retail-focused product, individual investor-focused product, it's shorter research. You don't regurgitate G&A per BOE and all the stuff that the institutions want. We talk about why you want to buy the stock, what's a good price to buy it at, where we think it'll go in a year, where we think it could go over the bull market, energy bull market cycle. But we also have a section called balance of evidence. And in the balance of evidence, we talk about what we really like from what they're doing and what they did during the quarter or 2024 annual results, and then issues of concern. If there's too much debt, if the G&A per BOE is too high, if insider ownership is going down, anything that we see that's a problem, we note, and that's not something you see in normal research, and that's why we've had such a significant growth in our business. Is people like that independent view and like to hear the balance of evidence so that they can decide for themselves what's appropriate for their own investment needs.
Could the outcome of the Canadian election, April 28th, affect energy prices?
I believe it will, because if it's a conservative government which is pro-energy, the industry will be happy about that, because it means that we will have, many of the liberal bills that are, if you remember, Bill C-69, which is the anti-pipeline bill. There's others that are, where you can't talk negatively about the federal government's policies on anti-energy, and all the other things that we're seeing that are picking on one industry, not on the cement industry, not on forest, not on mining, not on aluminum smelting, so not on nickel. So it's a one industry attack by the Liberals. We saw that going back to Daddy Trudeau. And so I think that if the Liberals win, it would be a negative for the Canadian stocks, and they would probably weaken. And if is a victory for the Conservatives, majority or minority, just having them in would be a sigh of relief that maybe rational behavior will come back, and the Canadian energy industry won't be the one that's on the bullseye in terms of use, in the trade war.
What's OPEC up to?
Well, OPEC, in the report that came out, had a decline in their production in the last month. And that number was, I'm just pulling it out now, was 78,000 BOEs a day. But that's before OPEC announced that they were going to increase production in the next month, May, by 431,000. But we saw Iraq lose 34,000 as they were producing over quota, and they were being pressured by Saudi Arabia to pull their numbers down. Libya came down by 22,000 to 1.26 million. Going to Iraq, that's 3.98 million production. And then you saw, Saudi Arabia up 4,000 to 8.96 million. And then UAE was down by 21. The one that I want to draw attention to is Iran. Iran was producing 3.35 million barrels in the month of March, up 12,000. And then the other one to note is Venezuela, 911,000, as I mentioned before. That was 760 a little over a year and a half ago. So they were able to increase production. Now they're going to see that number fall in half, probably over the next couple of quarters.
We're seeing more and more electric vehicles from a number of automakers on the road here in Vancouver, I guess across the country. Could this be affecting energy markets now?
Well, if Tesla owners are worried about getting their cars defaced, or people doing terrible things, throwing paint at them or whatever, the anti-Musk situation is pretty strong everywhere. Again, EVs are, there's question about the batteries, and if they have a fire, as we've seen, the danger of them from California fires when they go to take a damaged or burned Tesla, they have to be very careful about taking the batteries apart because they're toxic and the chemicals there. I think people are having a question mark on EVs. Also, power that they use, charging stations, we don't have enough of them yet. We need a universal charging port that can be used. And there's places, even in Calgary, where the power is not sufficient, that if we're at home and everybody's using power for, their stoves or for heat and electricity and lighting and all the rest of it, that you don't want, that they tell you not to charge your cars, because we just don't have enough electricity. And there's been a number of times when we have a shortage of electricity that, we get a warning saying, please cut your electricity use. I think that's going to become a bigger and bigger problem because we're not really building a lot of new, plants for electricity. We're not doing coal-fired. Nuclear takes a while. LNG, natural gas-fired electricity takes time. Hydro is, there's no new really big hydro projects coming on, as we found with, the BC government, where they said LNG projects need to be compatible to take hydro electricity, but until, BC Hydro can produce it, they're allowed to use natural gas. So I think everybody's coming to the realization that the immediate desire to go to the cleanest technologies, wind and solar and all the rest of it, is not happening. And you're even seeing backpedaling totally, where Germany is willing to leave their coal plants open, and Trump is saying he wants to leave coal-fired electricity open. So the go-to desire for the climate, especially in Europe, is being backtracked because they realize they don't have enough power, and if people don't have power, they throw governments out.
Do you think we'll ever see an energy pipeline east in Canada?
Not in my grandchildren's lifetime. Again, the problem we saw yesterday with the bloc is that they don't want anything through Quebec, and if you can't put a pipeline through Quebec, you can't put it through the States because of all the tariff issues. So and the cost of doing it is just so prohibitive, as we saw with the TMX and with Coastal Gas. what everybody thinks is going to be the cost just explodes because they go through difficult terrain, the First Nations issues. There's just so many things that can make it troublesome. And remember, going through, northern Ontario, Ontario north of the Great Lakes, it's difficult terrain. Do you put the pipe in the ground through the rock? Do you do it above, like the Alaska pipeline? All of these things just are going to be unbelievable costly. Then you go through Ontario. Then can you get through Quebec? I think that it's impossible that we have that. The big thing would be is if Quebec reverses its stance on natural gas. There's a lot of natural gas that was found between Montreal and Quebec City, and it's still sitting there. And if Quebec was smart, they would use that natural gas for their own purposes, so they have domestic gas in the province, and then they could use that to create electricity. Remember, if there were attempts to build battery plants in Quebec, EV battery plants, but they just didn't have the electricity from Quebec Hydro, so they ended up moving and building those in Ontario. So again, Quebec has got a problem with a shortage of electricity. And there's no easy solution for them, to build new dams and hydropower in Labrador, even with the new deal with the Newfoundland government. It's still going to be lengthy periods of time before any new electricity comes on. So to me, I think Quebec is kind of put themselves in a corner where they're going to have to reevaluate their views on fossil fuels.
I was born in Calgary. I grew up in Alberta. Oil and gas are everywhere, and I don't recall any major problems caused by it. Why are Quebecers so against exploiting their own natural gas and building pipelines?
Being from Alberta myself, I'm perplexed. Like, when there's times when you hear in Alberta where people are so annoyed by Quebec saying, "Oh, we need more of this from Ottawa," and that they need, that they need to have separate issues on migration and all the rest of it. There should be bigger transfer payments to them, they're against fossil fuels, and there's people here who say, turn the switch off. Don't send them oil, don't send them natural gas, and let's see how long their economy stays alive.
Josef, can you tell our listeners where they can subscribe to the Schachter.Energy report?
Sure, my pleasure. People just go to our website and they can see some of the complementary research there, and then they can see the Ion Energy, which is free, and they can just subscribe to that. And then if they want the company specific, then they need to go and take either a quarterly or annual subscription. The website is www.Schachter, is spelled SCHACHTER, energyreport.ca. So www.Schachter.energyreport.ca, and they can find all the information there. And we'd love to have them become part of our subscriber group.
Josef, thank you so much for being on This Week in Money.
My pleasure as always, Jim.
My guest has been Josef Schachter, founder of the Schachter.Energy Report, online at Schachter.energyreport.ca. He was speaking to us from Calgary. Our conversation took place on Thursday, April 17th. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, Rick Ackerman, and Josef Schachter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.